asset that's worth $100,000, and let's say we can depreciate over 10 years, on our books we're going to take $10,000 a year. For Section 179, we can write that thing off right away, so we've written off $100,000, so our balance sheet looks like we have $100,000 of less value. Where for books that's allowed to do straight line, we've increased our equity by $90,000 with just a simple journal entry by making sure you use book depreciation for your financial statements and tax depreciation for your financial statements. Ask your CPA if you're doing that. If not, ask him why you're not doing that. I was amazed when a banker told me that there are a number of companies that do not have two methods of depreciation. They use tax depreciation for book and for tax. And that should not be allowed by any company in this room. So that's a good question to ask. Are we using book and tax depreciation? It's the best of both worlds. You get to show equity on your balance sheet, and you get the immediate tax deduction right now. Totally allowed by the IRS. Something all you guys should be doing. Inventory. This is one of the things that a lot of you guys have more inventory than necessary. I've asked a lot of my electrical contractors lately, how much inventory do you have on the books? And they're amazed at how much they have. And I say, do you know what the carrying cost of that is? You're using your line of credit to carry this much inventory. They say, well, a lot of times the guys go on the jobs, we bring material back, but we only have to order for another job. They don't want to see what's in the shop. And so we have all this excess inventory that we brought back, and then we don't use it. So right now, that would be one of the things in your job cost meetings to say, do we have the inventory in-house? Let's not go order it and work that inventory down. Because for one, the inventory is very costly as far as using your line of credit, and you got to store it, and then it could become obsolete. So I was a little amazed at how much inventory is out there, and a lot of contractors don't have a good control on their inventory. So something to take a look at. Yes?
Is there a percentage of inventory versus volume or anything that's acceptable or over or under, or is it just company by company?
I would say company by company, because a lot of times, some companies are more labor intensive, some are more material intensive, but the biggest thing that I see is people don't have a good handle on their inventory. That's the biggest thing. Yeah, so just make sure that somebody takes a good look at the inventory and use the inventory, because the last thing you want to do is have it become obsolete too. Liabilities, this is one thing. Make sure you have a proper cutoff each month. This is getting back to your financial statements. We want to have a good, clean financial statement, and we want to use the matching principle. What's that? We're going to match revenue against cost. So if we don't get all our liabilities in one month, we're going to have a financial statement that really fluctuate, and we don't have a good analysis every single month. The other thing you need to do is take advantage of discounts. I think you guys all know it's a lot cheaper to borrow on your line of credit if you can take the discount versus not taking the discount and not borrowing on your line of credit. Now I know a lot of companies aren't giving the discounts like they used to, but if you can negotiate discounts, I would highly recommend that you take advantage of all discounts. Also, make sure you accrue all appropriate expenses at month end. What do I mean by that? You have payroll that goes through the 30th. You're going to pay it on the 3rd of the next month. That payroll should be accrued as a liability this month. Those are things that the banks and bonding companies looking at to make sure you have a clean financial statement. What we're trying to do here is give your financial statements credibility. If you give your financial statements credibility, that's going to go a long way. Just like I said, paying your debt to the bank timely, not having overdrafts, making sure you pay all your taxes. Those things are more important today than they've ever been in the past. Debt, this is another thing you need to take a good hard look at. The landscape in the banking industry has changed. Make sure you review terms of your loan documents. You guys have probably signed loan documents, and the only thing you looked at is what is my payment every month and what is the interest rate I'm paying. There's a lot more to a loan document than that, especially nowadays. Evaluate subordination of personal loans to the company. You guys who have lent money to the company probably have in your loan documents today a subordination agreement. Do you understand what a subordination agreement says? It says that you cannot take the money back that you lent the company until the bank allows you to do that or until you pay the bank back. It may allow you to take your interest expense that you have accrued, but you cannot take that debt. So in a sense, that's considered capital to the bank. That's a subordination agreement. Personal guarantees, see if you can limit them. Tough to do nowadays. If you can't limit personal guarantees, can you have carve-outs? Maybe there's a way to have carve-outs, meaning that maybe only guarantee 80% of the debt because you have a strong balance sheet. Or maybe your spouse does not guarantee the debt. There are a lot of ways that we can try to eliminate your personal risk here, so why not take advantage of that? Make sure, and this is one of the things banks are looking at nowadays, they didn't do it before, your collateralized assets at a reasonable fair market value is more than your bank debt. A lot of banks are going in and taking a look at the collateral and saying, you know what? For example, your real estate that you're using as a collateral for your line of credit has gone down in value. Now the bank may say, we don't have enough collateral to cover the debt. What are they asking for? You to cover up the shortfall. So they're asking for what's called curtailments. So make sure your collateralized assets at a reasonable fair market value is more than your bank debt. Very important nowadays. Avoid excess collateral positions with the bank and try to avoid cross-collateralization. What does that mean? That means a related party company guarantees the operating company's debt. That's the reason we try to have more than one company, to try not to do that. But more and more nowadays, the banks are asking for cross-collateralization. With your equity, maintain a positive balance. Positive balance you have to have on your balance sheet. You cannot have negative retained earnings. Make sure your distributions do not violate bank covenants. A lot of times now, if you're an S corporation, what the bank is saying is you can only take distributions from that S corporation to pay your taxes. You cannot take excessive S corporation distributions. Understand what they're saying, because nowadays the banks are really taking a look at those covenants, and that could be a reason to call your loan. We don't want to give them a reason to do that. Here's some different ratios you guys need to be aware of. I'll put them up here. I'll go through them quickly. Liquidity ratios. It's number of days cash. It's your cash times 360 divided by annual revenue. It tells you how liquid you are. You should have your controller calculate every one of these ratios for you on a monthly basis and tell you, is it positive or negative? They will understand these ratios. If they don't, have them give us a call. Accounts receivable turnover, accounts payable turnover. These are all liquidity ratios. It lets you know if you're going to run out of cash. I won't go through them in detail, but they should understand that. Current ratio, something the bank and bonding company always take a look at. Very simply, current assets over current liabilities, it better be greater than 1 to 1. It should be greater than 1.2 to 1. You might want to have it 1.5 to 1. The higher that ratio, the better you are from a liquid standpoint. Working capital. Current assets minus current liabilities. One of the things that the bonding company takes a look at nowadays. Now, they have what's called adjusted working capital. Here are the things that the bank and the bonding company do from a working capital formula. They will take your working capital. What they will do, however, from a positive standpoint, they will add back your cash surrender value of life insurance, because that's considered an other asset or a long-term asset. That's a positive. However, what they will do, they will deduct any related party receivable. So that's why I say get rid of the related party receivable by the end of the year. They will also take your inventory, if you're lucky, at 50%. So they're going to ding you for the inventory, and they will also take out any prepaid items. Now, from a bonding standpoint, a lot of companies I'm seeing now are trying to go with SBA bonding because they can't get other bonding. The SBA does it a little bit differently. What the SBA does from a working capital ratio, they will allow you as an asset to add back any unused line of credit. So let's say you have a line of credit at $1 million and you only use $200,000 of that. From an SBA standpoint, they add back the $800,000 of unused line of credit for your working capital ratio. So if anybody does SBA bonding, make sure at the end of the year you have your line of credit paid down to next to nothing, because that's a positive for you from a working capital ratio. Then we have leverage ratios. Debt to equity ratio, banks are getting tougher on this. Used to be it could be 6 to 1. That means you could have 6 times debt versus your equity. Now they're getting down to 4 to 1. And then long-term debt to equity, profitability ratios, gross profit to sales, and then NPBT, net profit before taxes divided by annual revenue. One of the things I have not put on here that all you guys should take a look at, you go, what should my general administrative expenses be? How I take a look at that, and I'll say this very simply, look at your work in process. Look at the unearned gross profit on your work in process. So let's say you have $10 million of work out there, and you've worked off $2 million of that, so you have $8 million left. And let's say you're going to get 20% on that $8 million. 20% of $8 million is $1.6 million. Your overhead should be no more than your unearned gross profit on your work in process at any time. So every month you guys can take a look at your work in process, have your controller do this and say, okay, what's my unearned profit? As that profit comes down, because you're not getting work, that would be a sign to you to say, you know what, it's time to make some cuts. That's a very good ratio that a lot of people don't use, and I've used that for years with my contractors. That's one of the biggest ratios I think you can take a look at. That's a good indicator of, you know, it really is time to make the G&A cuts. And if I didn't say that slow enough, you know, email me or call me and I'll go through that with you, because that's probably one of the key things you should take away from this seminar today. return on assets, and then return on equity. Then we have the income statement. Look at sales. Are they at projected levels? What are the trends? Gross margins. What are the trends? Hopefully they're going up, not going down. Hopefully at least staying stable. Understand the difference between direct costs and G&A cost. You got to understand that. Prepare a break-even analysis. You got to say, what's my worst case scenario that I break even at different scenarios? Review all expenses monthly to the budget. Identify variances from budget. Understand all variances, make necessary adjustments. This is where it's very important that your accounting people meet with you on a monthly basis. You understand this stuff. Fixed versus variable cost, interest expense, depreciation. We talked about book versus tax. You need to know all these things nowadays. Cash cycle. Match the payment of your payables with the collection of cash receipts. Easier said than done. Establish a standard payment cycle. As we said before, try to pay only on the 10th or 20th a month and take advantage of all discounts. Purchase order systems, it should just be a given with this group. You should require purchase orders, and you should have a purchase order system. If you don't, install one right now. It's very basic. We have seen a 3% reduction in cost once a purchase order system is installed. Very hard to argue with that, so it's well worth doing that. Like we say, do not pay vendors weekly on request. Collections, we talked about establishing billing and collection policies, and make sure you establish follow-up protocol and hold regular meetings with staff to make sure all collection policies are followed. Have to follow up on your accounts receivables. Change orders, one of the things we talk about every year. I bet you once a year I have a contractor in trouble because I don't have good change order policies. Make sure you have a standard procedure to capture all change orders and require customer approval of the change order before performing additional work. I know sometimes it's hard to do, but I've seen more and more companies get burned on the change orders than anything else. Subcontractors, make sure you get highly effective bids from quality subcontractors. And another thing I've seen is some people allow subcontractors to change their pricing once they've signed the contract. Do not allow that to happen. We talked about taxes before. Make sure you pay all your taxes when due. Be aware of all taxes, save for tax estimates. Nothing worse that comes up at the end of the quarter, you're an S corporation or LLC, and you don't know how much your taxes are or you haven't saved for it. Make sure you do that. Payroll taxes must be paid timely. I also put in here union benefits must be paid timely. They are a very expensive form of borrowing. Do not borrow from the government. The penalties and the interest will kill you. However, if you do get into a situation where you're behind on your payroll taxes, make sure that you get with a good CPA or tax attorney and consider an offer in compromise. The IRS is becoming more lenient on that nowadays. So if you happen to borrow from the government and you can't pay them back, there is a potential way out, and it's called an offer in compromise. So if you're in trouble like that, consider that. Overbilling. In years past, that was always a positive thing. Unfortunately, overbilling can lead to cash flow problems because it can give you a false sense of cash flow. So if you're in an overbilled situation, understand you haven't earned that revenue yet. I know it's a thing that people like to do for cash flow purposes, but use it for the proper reasons, not for the improper reasons. General matters, we've said this before, hire competent advisors. As far as your advisors go, you can't go on the cheap. Hire competent staff, same thing, you can't go on the cheap. That will only hurt you in the long run. As far as S corporations, understand the difference between salary and distribution. A lot of tax effects that you can have right there. Related party transactions, we said before, make sure they're at arm's length and they're documented. Related party rents, they must be at fair market value. Banking relationship. In today's environment, I think everybody here should evaluate their banking relationship. The world of banking has changed. Make sure that the banker receives accurate and timely financial data. Make sure you receive accurate and timely management data. Another thing you must do in today's environment is you must have weekly job cost meetings. It should be one of those things where it's just mandatory that you do that. Make sure you document all change orders. If you have adjustments to gross profit, make them immediately. I just had this with a client. They had like a $2.5 million job. They were going in at 18%. When we got done with the job a year and a half later, it came in at 7%. They carried it at 18% that entire time. You know what that did to their financial statements when we made that final adjustment? Killed the gross profit, also killed credibility with the bank and the bonding company. If you have a reduction in gross profit on a job for whatever reason, demand that your accounting department makes that adjustment right now to your financial statements. You may not like it, but it's the truth. You have to get it done immediately. Do a business projection. Do one that's optimistic, one that's realistic, and one that's pessimistic. If you can live with the pessimistic one, you're going to win. And also prepare a cash flow projection. You need to do that. Communicate with employees your goals, what the results are.